Hello, everyone, and thank you for joining our Q1 interest rate webinar. For those of you that recognize my voice, I'm Sarah Conklin, co-host and producer of the Rate Guy podcast, and like JP likes to say, the real boss here at Pensford. Before we get started, here are a few quick housekeeping notes. Presentation slides will be sent out to everyone after the webinar, so be on the lookout for that. And we'll be doing a Q&A at the end, so please put your questions in the chat and I'll pepper JP with them as soon as the presentation is over. And now, here is our interest rate expert and utterly heartbroken Philadelphia Eagles fan, JP Conklin.
Well, thank you so much for that warm introduction, Sarah.
You're so welcome.
And thank you for everybody for joining. One last housekeeping note before we dive in. Sarah makes me do a commercial for Pensford and Loan Boss, so you'll have to bear with us for 30 seconds. Pensford had its best year ever last year, probably like a lot of people on this call. Also very first half loaded, probably like a lot of people on this call. But one of the things I would point out is that last bullet point is right now we're spending a lot of time doing LIBOR to SOFR hedge modification. So if you have a LIBOR-based hedge and the bank is asking you to transition that to SOFR, make sure to give us a shout because it should come with some savings for most of you guys. On the Loan Boss side, if you haven't had a demo, I would just ask that you do a demo. Everyone who does gets off the phone and says that was so much better than I was expecting, which is refreshing for us to hear every once in a while. And I think the overarching theme for both companies is we are very relationship focused. For those of you who are on the phone and helped us have our best year ever, thank you. I would hope that you can attest that we're extremely focused on the relationship, and that also extends to the software business. So, Sarah, I think you mentioned this is our second webinar now. We are old hands at this. We got a lot of great feedback, or at least feedback from the last time around that I think we wanted to share with everybody so that they could get a feel for how well received the first webinar was. I don't know if there's any that jumps out at you, Sarah, but I just
well, I mean, I got a compliment. So, I mean, there was that.
Oh, that's the one you stuck in there. Got it. Okay. And then also one of the things that we did learn is it's not good to have a webinar in the morning because the West Coast won't join. So lesson learned. So we're trying to do better this time around. We do, however, have one diehard fan. And,
we do.
And so what you're looking at here is newborn baby Isaac. Apparently already my number one fan. I soothe him to sleep 3 times a day. Talking about interest rates, Warren has assured me that this is related to my voice and not to the boring topic of interest rates. So I figured, let's give the fans what they want. And I sent them an autographed picture of myself. So Warren, if you haven't received that yet, I think I just spoiled Isaac's baby gift, but there you go.
Wait, is this the start of a Rate Guy merch situation?
If anybody pays anything for Rate Guy merch, I'm shutting it down. All right,
duly noted.
Let's jump in. I know everybody's busy. So let's start with my favorite graph. So this is financial conditions. I like to say that if rate hikes are kind of the input, financial conditions are output. This is not just me saying this. This is what the Fed says. This is what Powell says. So you guys have seen this before. Anything above the gray horizontal line is considered restrictive or sort of applying the brakes. Anything below the line is accommodative, kind of applying the gas pedal. In this bottom right-hand corner, this is where we were a year ago. The Fed started hiking. We were at the most accommodative situation ever, and that's why so many of us were so busy last year. The Fed quickly squashed that. And so we actually peaked almost at the recession threshold in October, and then it came back down. And this is a big deal. And Powell has mentioned this in his press conferences, that this actually worries him because it's not cooling off the economy. It's not having the desired effect. And so he has pointed out that the market, by pushing these conditions back down, has basically forced the Fed's hand to hike more than they would have otherwise hiked. So keep an eye on this in the coming months and quarters to see, do we stay up in this green area? Do we position up above the yellow recession line, or do we actually move back into more accommodative? We're right on the Mendoza line right here. So it'll be interesting to see where we go in the next couple of months. I suspect we will continue to tighten as rates continue to move. We're going to get into the weeds a little bit with some inflation stuff, some rate stuff. So I thought maybe we just step back and just big picture. inflation has improved. It's hard to recognize that when every single headline is inflation, inflation, inflation. But we've actually seen quite a bit of improvement since the Fed started hiking. We actually peaked last year at 9.1%. So we're down almost 3% in 9 months. It's not the worst improvement of all time. I think maybe that sometimes gets lost when we're dealing with the individual month-to-month gyrations of inflation, but in general, things have cooled off. Same message with GDP. If you go back to pre-COVID, we were sort of in that 2.5% range average over the course of a year. 2021 was 5.75 with a couple 7 handles. Right now, or 2022, was 0.9%, sub 1%. And even if I toss out those first 2 quarters, you're still like sub 3%. So it is definitely cooler than it was in 2021. And this is important because when Powell first hiked, he said, hey, this is going to be 12 to 18 month lag. And we're seeing some cooling. We're seeing inflation move lower. And that hasn't even hit. It hasn't even been a year yet. It's hard to imagine, but we're going to be at the 5% mark in 12 months in a couple of weeks. So to me, I'm a little worried that we are expecting different results, even though Powell set the stage that, hey, this is going to have a lag to it. So let's jump into rates. This is what everybody's here for. In recent appearances, Powell has said the disinflation process has begun. He has said that several times. It was clearly an intentional statement. And I have to wonder, after Friday's core PCE number, does he regret saying that? Has he boxed himself into a corner? So Friday, we got hotter than expected core PCE. The market is now pricing in 3 more 25 basis point hikes through June, which would put us up around 5.5%. There's about a 9% chance that we'll hit 6% at some point this year. And the market right now says if that happens, it'll be in the fall. The further out you stretch that timeline, however, you start to pick up the back slope of the curve, and the market says they're going to be cutting at some point. I've heard a lot of chatter about moving back to 50 basis point hikes. I think it's possible, but I think it's a high bar. I think we would have to see a couple, probably 2 or 3 inflation readings that are actually reversing the other way before they would do that. Last year, you guys may recall, we had 2 different sort of pump fakes where inflation was coming down and then temporarily bumped back up, came down, temporarily backed up. The Fed's got to see, was Friday an anomaly? Was that just that little bump in an otherwise trended lower, or is it going to keep reversing course? If it reverses course, everything's on the table. Assuming it doesn't, and it just continues to move slower than people would like, but it's still moving lower, to me, the main takeaway from Friday is that time will be more important than the peak level of interest rates. And what I mean by that is whether we stop at 5.25 or 5.5 or 5.75, is it really going to be that big of a difference? I was watching a very well-respected CNBC commentator today say, no, they're going to have to get up to 6. And my question would be, if the first 5% didn't do it, and the market's already pricing us into 5.5, why is that last half point going to suddenly declare victory on inflation? I think the Fed is moving into this position where they said, listen, we did 5% in 1 year. It's borderline unprecedented, other than in the Volcker era. We need to give this time to work its way through the system. And so Powell would love for inflation to cooperate so he could stop hiking. Right now, it's not. But he can't stop talking about hikes, because if he does, the optics are terrible. Inflation just reversed course, and you're now downshifting to no hikes and trying to persuade us that you just need 6 to 12 more months. Are you behind the curve again? So I think he's trying to thread the needle and essentially say, fine, we're going to keep hiking in 25 basis point increments, slow and steady, hoping inflation will keep coming down and he doesn't have to reverse it and take it back up to 50 basis points. I think his overarching message would be, guys, if we get to 5.25, 5.5, and we leave it there for a year, 6 months in, if we're seeing inflation take off, I'll start hiking again. But let's give it some time to work its way through the system, because we said that from the get-go. There's a chance, in my mind, this isn't Powell's words, there's a chance that the improvement we've seen in inflation so far has been more closely tied to supply chain issues resolving themselves. You guys may remember at the December webinar, I said, some percentage, some proportion of the overall inflation problem is supply chain, not demand. Those supply chains have resolved themselves. We actually stopped including them this time around because everybody's seen a million of them by now. But they're largely resolved. So isn't there some chance that this this nearly 3% drop in CPI in the last year is attributable to supply chain pressures easing, and now the baton is being passed over to monetary policy, and we need to give that time to work. As you can see, the market is not really expecting 50 basis point hikes. It is saying we're going to get up to 5.5. No cuts this year, which I didn't think we would have anyway, but I think that is borderline locked in, barring a complete implosion of the economy in the second half. But 2024, the cuts are coming. It's got market's got Fed funds back at 4% by the end of the year. Real rates are probably the one thing that I missed the most when we were talking about the Fed needing to hike. And this came from about a year ago at the first hike, and the Charlotte Fed economist was gracious enough to very politely point out that I was missing the boat on this. So if you're on, Matt, thank you. But one of his points was we need to get into positive rate territory. That's when the Fed views, really we're applying the brakes at that point. We literally just crossed this threshold. Like, this is brand new territory. So in the Fed's mind, they have not been applying the brakes for the last year. They've essentially just been easing off the gas pedal. Now that we're into positive territory, they are applying the brakes. Okay. Now, Powell has not given us a target for this quote unquote real Fed funds, which is just Fed funds minus inflation. He has insinuated it's probably in the neighborhood of 1 to 1.5%. Okay. So to me, what he's basically implying is take core PCE, add 1 to 1.5%, and that's where Fed funds will go. Okay. And so we put this table down here together, and I just used the Fed's own projections. 3.5% at the end of this year, 2.5%, 2.10. This 350 is stale. In a couple of weeks, they'll revise this, and I would bet it'll be higher, and it might be 4%. So let's use that as an example. They revise this to 4 at year end, add 1.5, the implied Fed funds is 5.5, right? So it's something to keep an eye on as we move forward. But the takeaway remains the same, that if the Fed cuts this year, it will be because inflation falls faster than expected, not because of economic pain. The Fed views themselves as playing with house money at this point. The economy is so strong, the labor market is so strong, they have a ton of rope, and they will keep hiking in the face of unemployment going from 3.5 to 4.5. I personally believe that it's a little convenient to be talking tough when unemployment's at 3.5%. We'll see if they can really weather that storm once it gets above 4.5 or 5%. They hope it doesn't come to that. They hope they have a soft landing. But just because we see the economy roll over, do not expect them to back off if inflation is not cooperating. So a couple different measures of real rates, and these are far more sophisticated than the back of the envelope one I gave you, suggest that we're already in positive rate territory. So here's a 5-year TIPS. It's been around 1.5%, 2% since the fall. Like, it would argue that it has been restrictive since the fall. And that's why we're seeing the slowdown that we're starting to see. And our good friends at SMBC, measuring the 10-year real rate, they conclude that we're actually at levels that are higher than 2008 and more than a 2 standard deviation move. The main takeaway to me here is we are in restrictive territory, that the Fed did not just now start applying the brakes. The brakes have been applied. We're just a little bit slow to acknowledge it, and the fact that it takes a while for the car to come to a complete stop. Unfortunately, what this means is cap costs are expensive again with this recent surge in rates. And so you can see out here, we had peaked in sort of late November, early December. We're back up at those levels. The 1 and the 2 year are actually above those levels. And that's because now an option trader has to price in, all right, I'm going to be paying out up to 5.5% instead of 5. The 3 year is basically at the same level, and that's because it's picking up the downward slope of the curve in the future. The 10-year Treasury broke above 4% today. That's a key level. Next stop is really 424 from a technical perspective. If it gets above that, all bets are off. I will be stunned if we blow through 424. If we move lower, the range is really 340, and then after that, 3.25. So I would expect us over the course of this year, as negative data comes out, as all this tightening works its way through the system, the 10-year Treasury to trend back lower. I think there's a much greater chance that the 10-year is at 3% at year end than it's at 4%. So let's talk about everybody's favorite topic, inflation. This to me is the biggest concern if I'm Jay Powell, and that is inflation expectations have climbed again. And we're back at levels that we didn't see since last summer. This is a big deal. And this is why he'll keep talking up rate hikes. Even if he eases us along 25 basis points at a time, he will not change his rhetoric right now, because these expectations are what scare him the most. This is what leads to inflation becoming entrenched. And last time we did this, I had that 1970s, 80s graph that just showed how Powell has learned the lessons from that time frame. Inflation got above 2, didn't get below 2 for 20 years, right? We're 20 months in, and that's all anybody talks about. Can you imagine being above 2% for 20 years? Powell is looking at that saying, the reason inflation became entrenched is because expectations became entrenched. It became part of everyday vernacular. He wants to squash that. So he will keep talking tough to drive these down. And I actually believe that this is more important to Fed policy than where Friday's core PCE came out. Friday's number was set in motion a year ago, right? If he hikes 50 basis points this month, do we really expect that suddenly in June everything's better? That's not going to happen. But he has to keep talking up hikes to drive the expectations back down. That's what he's most worried about. And what we're seeing is the tale of two inflations. And you guys have probably seen a lot of different measures of inflation. You know, everyone knows CPI, then people have probably gotten familiar with core PCE. Then we start looking at, you know, the monthly numbers, and we just like keep honing in on more and more specific measures of inflation. But what you'll see here is we've got a tale of two inflations. A lot of goods inflations have collapsed, right? They've just fallen off a cliff. It's the service industries that are really experiencing that, mostly driven by wage pressures. And so we're really just mostly worried about this at this point. And I think that this number falling is a good signal, but we've got to figure out how to rein this in as well. And that leads us to this supercore inflation that I'd never heard of until a few weeks ago, which is really just meant to further strip out the house prices, right? And this goes back to where people get frustrated about conspiracy theories, where it's like, well, housing is down huge, so that would drag the number down. So the Fed just says, you know what, let's take that out then. Let's stop measuring that. Inflation is still going up. I got to keep hiking. Well, how much data do we need to cherry pick before we just say, you know what, inflation is actually moving directionally correct, even if it's not at the pace that we're going? To me, there's a lot to be discussed about money supply and velocity of money. So the money supply for the first time ever actually turned down. Okay, so this is things like the Fed quantitative tightening. This feels like a big deal to me. I added this line to just sort of suggest, imagine this running and these two meeting at some point, like a trend line, because we didn't have inflation, right? The money supply was growing. We had a ton of stimulus. We had 0% interest rates from 2009, 2020, no inflation. And then all of a sudden it just spiked, right? And I suspect it's because we broke trend and came up here. Well, if this comes down and meets the trend line again, does that mean the inflation situation has resolved itself? And, you know, keeping on the same theme, the velocity of money changing hands. You can't have inflation without money changing hands. So in 2021, I'm running around with this graph saying, look, there's no velocity. Money's not changing hands. We can't have inflation, right? If I just waited a couple more months, Jan 2022, guess what? It took off. And with it goes inflation. So I don't know what this is going to be, but based on the fact that this or the January core PC number came in at 4.7, it suggests to me that velocity is probably still accelerating. And this is what the Fed is going to have to tamp down. I personally am in the camp that most of this is around helicopter money, right? So you look back at all the stimulus that was dropped on to people, the fact that they weren't spending money on things that they normally would have, excess savings went through the roof. This is a JP Morgan graph that just illustrates that peak excess savings in sort of mid to late 2021 hit 2.1 trillion. That's excess, right? That's just helicopter money, got dropped on the economy, go do what you want with it. Well, up until that point, people haven't been spending money. Now all of a sudden they got $2.1 trillion to go blow on whatever they want, right? Well, guess what happens? They started spending it. And over the course of last year, that number came down. And this is actually from Q3. And we were already below $1 trillion. So people are spending that money. And this is a great graph from the Fed. We actually emailed them and asked them if they had updated because I love this graph so much, and they hadn't. And it was too complex for a couple of state school kids to figure out to update. But what it said was, as of June 30th, the bottom half of income earners had already gone through all excess savings and were upside down. The 75th percentile, which is generally about 130 grand a year, were just barely clinging to excess savings. All of it is in the top quartile of earners. And so I suspect that this trend just continued since then. It's been 9 months since this was last updated. I suspect that all of these are negative and that this one has come down somewhat. And so I read the data and I says, okay, well, consumers are still spending money. So what's going on if they're blowing through all of that? Well, number one, they still have jobs, right? We haven't felt any significant impact from layoffs, so people are still spending money. More importantly, they're transitioning to credit card spending, right? And so the savings rate collapsed, and this little tick up here is not a positive sign. That's usually what happens when you head into a recession. People stop spending money and they just start hoarding cash. Right now, because people still have jobs and they're still feeling optimistic, credit card debt has surged. And the Wall Street Journal had this really good article about how much it has spiked, in particular for millennials. And I like to banter with Sarah about millennials. They kind of drive me nuts. But it's because they're spending money at a historic clip, even if it doesn't warrant it, right? And so it is going to come home to roost when you factor in what interest rates are doing. So another graph from SMBC that shows when you sort of aggregate the different types of debt that people have, whether it's homes or car loans or credit cards, the effective rate's around 7.5%, which is the same as it was pre-financial crisis. So we've got a surge in credit card debt. Car loans are falling further and further behind. The interest rates on all of this debt are surging. To me, this means we have to have a slowdown. And we just haven't given it enough time to work its way through the system. And it's not just the millennials that don't know how to spend money. Our own government does. So we get a lot of questions about the debt ceiling. And the answer historically for me has been basically nothing, right? It really has no large effect. Number one is there's a sticky argument to be made that the U.S. is constitutionally prohibited from defaulting on bond payments, okay? So when we hear like debt ceiling and default, what people frequently mean is they're not going to pay Social Security or benefits to veterans, things like that. It's usually not actually around the bond payments themselves, which constitutionally we're not able to do. Powell, 10 years ago, was actually heavily involved in this between 2011 and 2013 when we had a couple different instances with the Tea Party. And what he said was, yes, constitutionally we're not allowed to, but practically speaking, the Treasury's not set up to pick and choose which bills to pay. So he didn't really know how it would go if we were to break that threshold. So he will be spending a lot of energy himself saying, we can't do this. Like, do not mess with this. Just get this done somehow. Another Wall Street Journal article pointed out, and in the grand scheme of things, the U.S. is collecting $450 billion a month in tax revenue and pays $55 billion a month on debt payments. It's okay. It's got cushion. And then there's really only one time that we were truly in default, and even then, it was a technical glitch, not like we breached a ceiling and we didn't pay our bills. So, in general, the answer is it's not much, but it's one of those things that could have a huge impact if we were to actually just not pay our bond payments. We tried to see if there's any sort of correlation around, like, do rates surge or retrace heading into sort of a debt ceiling showdown? And the answer is we couldn't find anything. The only thing we saw was in 1979, but as everybody on here knows, there was a million other things going on. So it's hard to attribute that to a debt ceiling debate. So this brings us to the question of, will we have a soft landing? Exhibit A for soft landing. My beloved Phillies and Eagles figured out a way to choke away championships this year, particularly the Eagles. I'm going to go to my grave saying that we were the better team. And Patrick Mahomes didn't even do Mahomes things to win that game. We gave it away. But this historical correlation between Philadelphia championships and recessions would suggest maybe we can avoid a recession. I doubt it. So if you look at a couple different measures, we're pretty elevated. In fact, you look at this measure, this is from the New York Fed, this is from the survey of banks. We're at 60% odds. That's recessionary. You don't have to have 100% in order to enter a recession. So this New York Fed one right here, look where 2008 was. It was down here. So we are at extremely elevated levels right now. Leading economic indicators. Everything the Fed is doing is backward looking, and part of that's our fault because we keep harping on them. Core PCE came in hotter than expected. You guys aren't doing enough. It's like, well, yeah, but that was set in motion last year. Like, nothing that Powell does at the meeting in a couple weeks is going to change the following month's inflation number. And yet we all clamor for, like, do 50 basis points, keep hiking. You got to cut off inflation. And I would argue that that is a terrible strategy at this point, given 5% of tightening in 12 months. The leading indicators say we're in trouble. This is definitely recessionary. Domestic demand also about to break zero, right? So demand destruction was the primary goal of hiking interest rates. It has been achieved. Give it time to work its way through the system. Another measure is housing starts versus GDP. Usually housing starts lead GDP by about 6 months. You can see we overlaid those with the lag. We're about to break through recession territory. Okay. Inventories. There's this really good blog. If anybody wants to go read it, I don't know anybody there, but I love their stuff, the Real Economy blog. And one of the things that they point out a lot is the relationship between inventory buildup and recessions. And right now, the ratio is about, the ratio of inventory buildup to sales is about 2 to 1. Sales have fallen off a cliff. Retailers had stockpiled, like all that demand finally caught up all at once, and now they're sitting on all that inventory, and they're not going to be able to sell it, or they're going to have to slash and burn. Definitely an indication of demand destruction. And then lastly, as everybody here knows, lending standards have gotten extremely tight. I still remember in 2006 when we started to see some cracks in the system, our head swaps trader said a credit crisis is the worst crisis. And his thought was, if you can't borrow money to sort of compensate for the other shortcomings, you're dead in the water, right? And that's what we're seeing now. The people aren't able to access money just to get by. And so that's going to exacerbate the pain. Counterpoint number one from the Fed is the labor market. And this one is the one that drives me nuts. The thing that I will give 100% credibility to is wage pressure. We have felt it here. Everybody's feeling it. It's broad-based. Wages have spiraled out of control. Usually the only way to rein that in is by job losses. Step one, which is maybe what we're probably positioning into, is psychology, is that for the last couple of years, employees have felt like they can just demand raises, and if they don't get them, they just leave, and it's easy, and they're going to get paid more. I suspect that is coming to an end, but this is what Powell is laser focused on. I get it. I agree. It's something that has to come down, but I think it's going to take a lot of economic pain to drive this number lower, because this, to me, is a little bit like the opposite of what we saw after the financial crisis. After the financial crisis, companies were very reluctant to lay people off, right, to hire people. They were just stretching capacity to the max. This is the opposite. After COVID, it's been really hard to find people. So if you find them, you're not letting them go, right? And it'll be the last thing you do because you're just nervous that you're not going to be able to get people back. What's really interesting to me is that everybody keeps talking about how strong this labor market is because we haven't had any job losses. And I would say, well, yeah, but that's normal. We almost never see job losses in the first year after the Fed starts hiking, right? And we're coming up on a year. We're 2 weeks away from that point. January's number, 517 jobs gained, to me is a total anomaly. I don't believe it at all. I think the BLS adjusts their numbers every January, and January numbers in economics are notoriously noisy. And so people don't put a ton of stock into them. Even if you do believe that, and you say it's 517, and next month it drops back down to 200, 250, a more normal number. I would still argue it would be weird if we were negative right now. It would be borderline unprecedented. So why is this the signal that we have a super strong job market when really it's just behaving the way that it's always behaved? And in fact, if you look at the labor force participation rate and say, okay, well, if the same number of people were looking for jobs that were pre-COVID, then employment rate would be 4.3. Still very strong. The argument here is not that the labor market is weak. It's that it's not as strong as the Fed is holding it out to be, which makes me worried that they're going to overdo it based on a false premise. The BLS and the Fed likes to point that there are 2 job openings for every unemployed American. And that sounds like there's a million opportunities and we have a ton of slack in the economy. Private companies, however, paint a different picture. LinkedIn says, yeah, you're right a year ago, but that has changed. We're down to 1.5 and falling from here. The one that got my attention was last week, was ZipRecruiter. So on this one on the left is that JOLTS graph that I hate so much, because I think that a lot of these, with the advent of the internet, it has basically become free to have job postings. And you can just leave them up there. And if you're sort of looking at the last 3 years saying, man, it's been really hard to get somebody, I'm going to leave the door open. I call them zombie job postings. I'm not actually putting much effort into going through and hiring those people, but I'll leave it out there. That's what this is measuring. In 20 years of doing this, this has never been cited as an economic indicator until the last 3 to 6 months. And now all of a sudden we're using it to dictate monetary policy. ZipRecruiter CEO said, you know what? We have forward-looking information, and it's terrible. The hiring is slowing down considerably. In almost one day, they were down 29%. right? And they had slashed earnings, they had slashed guidance, and he had some interesting quotes that he calls them wait and see job postings. I call them zombie postings. He said the golden age for job seekers is coming to an end. Broad-based macroeconomic driven slowdown in hiring and sizable spike in job seeker activity, which he said is a leading indicator. Job seeker activity is a leading indicator. And so it makes me think the labor market is not quite as strong as we are holding it out to be. I'm not suggesting it's weak. I'm just saying it's not the strongest labor market in history. If you look at the Challenger report, which is sort of just tracks publicly announced layoffs, it's back to sort of levels that we've seen a few times in the last 20 years. If it continues, definitely a recession signal, but it's bad. It's surged, right? And that's what you see in the tech headlines in particular. The Phillips curve, this thing is killing me here. The Phillips curve was discredited in the 70s, and yet people are still clinging to it as if it's accurate. It was based on a study done on UK labor from 1861 to 1957. And basically the conclusion was, if labor is tight, we have inflation. And I think that it really took hold because it's a pretty straightforward concept. It makes sense. Intuitively, I can wrap my brains around that, even though I went to a state school, right? But when you look at the data, it doesn't really support that whatsoever. So we highlighted a couple of periods here where unemployment was below 4%. There are times when inflation is elevated. There are also times when it's not elevated. That means there isn't a correlation. And so looking to that relationship to dictate monetary policy is setting us up for failure. Assuming the Fed ever pauses, what comes next? So you guys might remember this from last time. We condensed it into one graph, so there's a lot going on here. But the dashed lines represent the forward curve on the day of the last hike. So whatever day we pause, that's what the forward curve said, basically flat for the next 3 years. Wherever they pause, if they pause at 5.5, market says 5.5 for the next 3 years. What ends up happening is the bottom falls out within a year, right? And sometimes pretty dramatically. The one example is 1994. And there is a scenario where I see this playing out this year, and we'll talk about that in a second. Otherwise, generally speaking, the bottom falls out pretty quickly. And so just because the market and everybody talking and we all have a tough time envisioning the Fed cutting doesn't mean that's not what's going to happen. And as you guys know from the last time, usually once the Fed pauses, they're on the clock. They typically are cutting rates within about 9 months. Longest is 15 months. So if they pause in June, let's say, then it really means Q1, Q2 of next year, they're cutting at that point. Cap prices, they fall pretty dramatically after the pause. And that's because they're made up of two components, volatility and rate expectations. Well, we just showed you rate expectations level off and then eventually they fall, right? So that drives down the cost. But also the volatility gets sucked out of the pricing. And so traders don't have to price in a 7% SOFR. They can say, you know what, that's at least off the table. While we're still climbing, I have no confidence that we can't get there, particularly since November 2021, Fed said they weren't hiking at all in 2022. Now we're 5% in a year. I have to price in some possibility of 7%. I'm going to charge you for that. Take that off the table, I can charge you far less. Unfortunately, we're in this part right here, wondering how long before the pause, right? Sort of the end of the year, we were thinking, okay, maybe we're in that final 3-month stage. Now with this data and market repricing, it's like, okay, now today maybe we're here and we're just trying to get to June. And then in the second half of the year, we'll see cap prices down. Same thing happens with the 10-year treasury, right? Implied forwards on the swaps just show that the 10-year treasury will come down. If you survey economists, a little bit lower, sort of 3.25. And then if you take the historical movement, it's actually significantly lower. And that taking where we are today at 4%, within 3 years, we'll probably hit 2% at some point. So this goes back to my concern that today isn't that unique. We keep reading about things in the headline that make it feel like it's unique, and we just say, "Oh, this is crazy. We got to end this." And I'd say, "Are we sure? Are we sure it's that unique?" Inflation doesn't usually plunge heading into a Fed pause, right? And in fact, it's usually above 2% heading into a pause. The one thing I'll call out here is the last 4 cycles, you can see the average was well below 3. Now the starting point was well below 5-6%. But it makes me wonder, is the Fed using this as guidance saying, you know what, we're not going to stop until we get that close? I don't think that's what they're going to do, but I think it's something to be mindful of. All the other scenarios, they stopped when inflation was far above target levels. So let's look at non-farm payrolls. Go back to that example I said where, the first layoff doesn't happen usually for at least a year and more frequently 2 years, right? We're adding jobs. Everybody feels like the labor market is incredibly strong. Everything we read in the headlines is incredibly strong. Well, on average, we're still adding 200,000 jobs a month heading into a pause, okay? It would be weird if we weren't, right? Again, January's number is an anomaly in my mind. If February replicates that, then I'll change my tune. But for now, I would say the trend is moving lower. And that 150,000 job gain is the recession line. It's not zero. Okay, that means we're not keeping pace with population growth, and that's contractionary. So we don't even have to get down to zero. We just have to get down to 150, and that's recessionary. The fact that if we're adding 200,000 to 300,000 jobs heading into a pause is not the most unique thing in the world. It would be weird if we were losing jobs heading into a pause. Usually, the Fed is cutting rates before we've lost jobs, right? Same concept with GDP. Right? The Fed has gotten very laser focused on very individual components of inflation. Okay, great. But in the grand scheme of things, GDP is usually doing reasonably well heading into a pause. And so if we're doing 3%, that's kind of normal. It would be weird if it had fallen off a cliff already. It hasn't had an opportunity to work its way through the system. And then even though I don't talk about stocks a ton because that's not my specialty, they're down or neutral most of the time, kind of the same thing that we're seeing. I think that there's more room for stocks to fall in the next 6 months as market continues to get caught up with expectations, but it doesn't need to be falling off a cliff in order for it to signal the Fed is going to pause. And so that leads me to professional Jerome. He's going to be all business this year. He will basically lead us to one of three scenarios in my mind. That Fed funds gets to somewhere around 5.25, 5.5. I'm not totally sold on 5.5 yet. Just because that number came out hot on Friday does not to me mean the Fed is hiking in June, because again, there's a lag. And if we see the next couple months show another downward trend, I think that there's a chance that they stop at 5.25. It will be 100% based on inflation data that comes out between now and then. That's it. So if you told me what the inflation was going to look like the next couple of months, I would tell you what my confidence level is for this. So I put that around 70%. I think that's the most likely scenario. The next two scenarios I kind of cut in half. And I said, we have a couple cuts by year end if inflation falls faster than expected. This looks less and less likely the further we get into this year. But it's reminiscent of the 94-95 cycle, where they raised rates enough to cool things off pretty significantly, and then they very quickly backpedaled. So imagine a scenario where we get up to 5.5, 5.75. The Fed says, you know what? Inflation's moving lower much faster. We can back off to 5% and reevaluate, right? We broke the back of inflation. Let's ease off some. And then the last one is the scenario. Rates go to 6% or higher. I put that at 15%. I wouldn't be surprised if it's actually lower than that, but you can't rule anything out at this point, particularly if the Fed continues to misstep once we get above sort of 5.25. And so again, my overarching theme here is the hikes over the last year just simply haven't had time to cause economic damage, but that is coming. And for those who haven't been by the office yet, that is an actual life-size cutout of Jay Powell we have here. This is business Jerome. 2023, he's going to be all business. So that leads next year. This is hopefully Party Jerome, and he goes by Jay. And so the Fed will be cutting rates at some point in 2024, Q1, Q2, but it is happening. And really the question is it slow and steady, or is it slash and burn? The higher we go and the longer that we're elevated, the more likely that the backside is a slash and burn strategy. So I think the Fed would love to break the back of inflation, call it off, start easing off, get down to a more normal level, and hopefully press the reset button on monetary policy. Let's get away from 0% being everybody's expected outcome and reset that number at 2.5% or something, and make that where we're going to cut to rather than zero, so we don't have to slash and burn. And so he is actually dressed up like that right now. We're huge Jay Powell fans here, so this is all done out of love and adoration, not mocking. We're just Fed nerds here. And so unfortunately, like Jay, I've also not had a great year, so I'm feeling it, Jay. I'm with you. I did a lot of practice climbing those poles, and it was all totally wasted. And so I was ready to go, and Eagles broke my heart. So maybe there's next year.
It's a good look right there. Yeah.
Yeah, I mean, I appreciate the Photoshop. I can promise you I look nothing like that in a tight t-shirt. My Supercore doesn't look like that, unfortunately for you.
Oh, I'm not taking that bait. No way.
Thank you. So I know I ran through a lot of stuff there. We will send out the slides. We've got a few minutes. Sarah, if you had any Q&A you wanted to run through, happy to take that now.
I do. Between the chat and the Q&A bots, I've got a lot. So
Okay.
buckle up. All right. So first one, if you aren't a floating rate borrower and you want to hedge against falling rates without the use of a swap, how would you do that?
So I want to hedge against rates falling.
Yes.
I would be mostly focused on two things, either a reverse swaption, which would help protect me. We use those when people are trying to hedge the defeasance. If I have a specific timeline, or I would use a floor. I would go buy a floor that would pay me out if rates were to drop below a certain number, and I can use that to help defray the cost of a prepayment penalty if I try to get out and refinance.
All right, the next one. Would you choose fixed or floating right now?
A very, very common question. And the answer is always depends on the business plan. To me, that is always the most important driver. If I'm a long-term conservative holder, fixed always makes sense to me. We do a lot of analysis that suggests floating rates historically pay out dramatically better than fixed rates. But that is strictly an interest rate play. That has nothing to do with the business plan itself. So it would require some discussion to understand that. But I think if in general I'm a long-term holder, fixed still makes sense to me. I would, however, be nervous about locking in today at what might be the peak and really, really conservative lending standards. Because I think there's a chance rates are lower and lending standards are more aggressive 2 or 3 years from now. And if you go do 10 years fixed, you might be stuck wanting to refinance. If you can find alternatives that are 3 to 5 years of fixed, or there's some sort of prepayment flexibility, I think that makes a ton of sense in the world. Floating rate borrowers, I would say, to me, still makes sense to be a floating rate borrower. That flexibility is still key. We're in one of those cycles that's super painful. I get it, but I wouldn't be thrown in the towel necessarily either. If I'm a floating rate borrower traditionally, and I can get a 3-year fixed or a 5-year with some prepayment flexibility, I might consider it just to be done with it, take that risk off the table, and go back to managing my business.
All right. So many coming in. So thanks everybody for participating. How does the fact that next year is an election year factor into the Fed's decision?
Really not much at all. And certainly not about anything right now. I think there's an argument to be made that they feel increased pressure heading into a recession, an election. But also, Powell's locked in through 2026. Like he is at no risk of going anywhere. So I think he's pretty secure. I think he feels like he can maintain his independence. In general, I think that the Fed does a good job of trying to stay independent and make decisions that are independent of that. But if we're in a pretty nasty recession and job losses have gone deeper than he had hoped, let's say unemployment's 5.5% or 6%, I think it's just only human nature to start feeling that pressure. I sort of talked about that at the beginning, that, yeah, it's kind of convenient to talk tough when unemployment's at 3.4%. But do you still feel that way if unemployment's at 6%? If millions and millions of Americans have lost their jobs, who, by the way, probably don't care about the nuance of measuring supercore inflation or wage pressure. They're like, whatever, I lost my job, I can't pay my bills. I think it's only human nature to feel that pressure. Otherwise, I think they do a pretty good job of staying out of the fray.
All right, so I'm going to combine 2 questions. The first one is greater probability heels make the tourney or the Fed cuts this year?
What was the heels make the tourney or the Fed cuts?
Which has a greater probability?
Probably the heels making the tourney, even though they don't deserve it. I just don't think that the Fed is cutting. The heels are going to have to go on quite the run to make the cut this year.
So on that, so will the Fed cut back to zero? Is another.
I don't think that's the base case anymore. I think that we have pressed the reset button. I think they're going to work hard not to. I think they would love to sort of make 2.5-ish the new normal and save that ammunition for really nasty downturns. If we do have a really nasty downturn, I do think that's definitely on the table. But my base case is not that in the next cycle they're slashing to zero. It's more like they're slashing to 2 or 2.5. and they try to say, like, let's get away from using 0% interest rates as a base case for the economy.
All right, we'll do two more. It's tough to pick. This is a long one. So if Fed funds normalizes at 2.5%, doesn't the 10-year have to normalize at a higher rate than that?
It doesn't have to, but yes, generally it would. I would say it normally would normalize in that environment around 3%. That assumes that the outlook for economic growth and inflation is basically upward sloping, that it's positive. The reason the 10-year goes below the front end of the curve is because of the outlook, right? If you're looking at buying Fed funds rate paper and you can earn 5%, that sounds great, right? 10-year treasury at 4%, so you're automatically making 1% more. That sounds great. But what happens a month from now, a year from now? Fed is slashing and burning. Fed funds is collapsing down to 2%, and you are now resetting each month or each 6 months or each year with your coupon, and you ride that all the way down, as opposed to you wish you'd sort of gotten in at the 4% 10-year treasury. So I would say yes, in general, it should normalize somewhere above wherever Fed funds settles, assuming that the outlook is generally positive and we think that we're not headed for a recession.
All right, we'll do two more. How will deglobalization affect inflation?
Yeah, this question has become a lot more common in the last year, and I would say I'm generally skeptical of the effect of deglobalization on inflation and the economy as a whole. I do agree that there is some element of that, but I just think it's mitigated. Everything is so interwoven right now. I have a hard time believing that we're suddenly going back to isolationist policies of the 1970s. Everybody across the world is connected somehow. All businesses are connected through the internet. I just have a tough time imagining that it will have a huge impact on that. I think it could have some impact on inflation, but we're talking like a couple tenths of a point, not 3% extra. And this is a new structurally different inflationary environment because of deglobalization.
All right, this is going to be a tough one for you, so just brace yourself.
Nice.
What are the odds of the Eagles making the Super Bowl next year?
Oh gosh, too soon. Odds are pretty low, unfortunately.
Yeah.
Going to lose a lot of players in free agency. We had 22 of our 22 starters healthy. We should have won the game anyway. So that was our year. We blew it. I doubt very highly that we will be back in the Super Bowl. I think we'll be a good team, but we're not going back in the Super Bowl. I will say with 100% confidence, it will not be the Dallas Cowboys, however. So it might not be us, but I'm guaranteeing it won't be the Cowboys. You can pin that and send it to everybody in Dallas.
Well, the person who asked that was a Dallas fan, so they'll get the
Good.
message on that one.
I'm glad I drove that point home.
Well, I think I would love to answer for you to answer all the questions, but I think we're about finished. Do you have anything else to add?
No, thank you so much for everybody for listening. We'll be back in June, see if the Fed is still hiking.
Yeah, and we'll send out the slides in PDF formats after the webinar completes. And thanks everybody for joining. Really appreciate it.
Thank you, guys.